will actually talk a little bit about that, the difference between the GDP change versus the GVA, the gross value added, change in the gross value added. I'll have something to comment on that in the next slide. I think this is, if you look at the overall numbers from Q1 onwards, Q2, Q3 and Q4, if you would recall, after the Q1 numbers had come, we had mentioned that things should become progressively better, and we had projected positive growth for Q3 and Q4. It's heartening to note that those projections seems to have transpired. I think the overall numbers, if you look at the annual numbers, they do signify a steady revival of demand. But as I will mention, that some of the momentum that was gathered on this has been affected by the second wave of the pandemic, and I will talk about that. Agriculture has been the silver lining with 3.6% growth in the fiscal year. Let me just show in terms of the overall math. So as I mentioned, after the 24.4% decline in Q1, 7.4% decline in Q2, then 0.5% and 1.6% for Q3 and Q4 respectively. In the that's what you see on the on the left chart. And annual numbers, as you see, is 7.3% compared to the second advance estimates of 8% decline. So I think the decline of 7.3% is primarily because of the impact of the pandemic and which impacted the first two quarters, especially the first quarter, significantly. As I mentioned, I think it is important to look at the differences in the change in the GDP versus the GVA for the last two quarters and for the fiscal year. The change in the gross value added is more indicative of overall, the change in the economy. Especially because of this being a pandemic year and the significant increases in the subsidies that were given, also because of the change in the accounting treatment, as the Honorable Finance Minister had mentioned in the budget speech, on bringing the off-balance sheet items on balance sheet together. What we get, because GDP is GVA, gross value added, plus taxes minus subsidies. So in Q3, Q4, and in the entire fiscal year, subsidies have been significantly higher because of the abnormal year that we have been in. Therefore, the overall growth, if you see the net taxes, which is your taxes minus subsidies, the growth in net taxes has been minus 18.4%, and this is primarily because of the significant increase in subsidies and to some extent the change in the accounting, in the reporting methodology, and so in the reporting of balance sheet items. So there is this wedge between the GDP growth rate and the GVA growth rate. From an economic perspective, at least for Q3, Q4, and for this year, the GVA, the change in the GVA is more representative of what has happened in the economy. But this is just for, I would think this would be for the exceptional circumstances that we are in. Overall, as always, GDP change is a far better indicator of the change of the economic impact. But given the large increase in subsidies, I think this is something that we have to keep in mind when we are reading the numbers. I think for Q3 and Q4 and for the fiscal year, we should look at the GVA certainly in conjunction, at least with the GDP growth change, because if you see GVA change is 3.7% for Q4, while GDP growth is 1.6%. Now let me talk about many of the high frequency indicators, how things look overall on an annual basis. I hope that these are, I'm sure you should be, there's a little bit of the left part that is cut off, but I'm sure you're able to read the variables here. So these are all the high frequency indicators that we track on a regular basis. What we are showing here is not only the change on a yearly basis, which is the 2021, March 2021 versus March 2020, but recognizing that the March 2020 base may have been lower because of the onset of the pandemic. We are also comparing with March 2019 to provide a 2-year view on the change. The color coding here reflects green is positive and red is negative. So if you see on an annual basis, clearly this year compared to last year, March 2021 versus March 2020, see a lot more greens and yellows. But I think it's better to do a comparison pre-pandemic 2019 versus 2021, where except for, if you see the domestic air passenger traffic, which has declined by 46%, you will see the rightmost column, that's what I'm referring to, 46%. Many of the other indicators are actually have done better. Either they are marginally negative or they are positive. For instance, tractor sales, fertilizer sales have grown by 37% and 71% respectively. The PMI index, the Purchasing Managers Index, which is oftentimes a good indicator of the view that that people in the market have about how things are likely to manifest going forward, has also is also in positive territory. Overall, I think one of the key aspects of the pandemic has been the growth in the digital economy. As you can see, that is reflected in almost between 250 to 300% increase in the digital payments, 240% increase in the actual numbers, and in terms of amounts, 275% compared to F2 2019. So these are the indicators on the domestic side. If you look at the inflation and the external sector, inflation overall, the WPI increased by 7%, CPI by 6%, and CPI food by 5% in March 2021 vis-a-vis March 2020. If you look compared to a 2-year period, then these numbers are a little larger because of the 2-year period. I would like to highlight here the change in the exports, the merchandise exports, and especially the non-oil exports and non-oil, non-gold imports, which are the non-oil, non-gold imports are a good proxy for demand. If you look at the rightmost column, over a 2-year period, merchandise exports have grown by 5%, with the non-oil exports increasing by 6%. I would pay attention to the FDI amount. If you see, the net FDI over a 2-year period has increased by 150%, with net FPI down 51%, and GST collection is up about 16% over a 2-year period, 27% higher compared to a 1-year period. So these are all the sort of the high frequency, some of the high frequency indicators of the close to 60 indicators that we track. These are some of the ones that we felt we should share with you in terms of the change over a 1-year period and a 2-year period. I think lastly, if you see the Sensex also, some of this is reflected in both the Sensex and the Nifty as well. The non-food credit, I think this is something I will come to later, has grown by close to 12% year on year, which you notice in the last column, and the third row from bottom, non-food credit, which I will actually go into a little bit more detail later. So if we look at overall now some more view from different segments of the economy, the food grains production is expected to be at record levels in this year, in the coming year, given the normal monsoon that has been predicted by the meteorological department. So this is reflected in both in cereals and pulses, and within cereals both in rice and wheat as well. If you look at over the last 1 year, rural demand has been resilient. The left chart here shows the tractor sales, both the level of the sales and the year-on-year growth. The year-on-year growth is shown as the line with the actual levels in the bars, and you see that domestic sales have actually been resilient and have come back to pre-pandemic levels, and and growth has been good in the last several months. Similarly, if you see for the fertilizer sales as well, here not only is the current level shown, but also the level as of last year same period, which is your COPPY. That's a corresponding period of the previous year. You see that being shown in the blue bars there, along with the year-on-year growth. Both of these fertilizer sales and tractor sales are reasonable indicators of rural demand. They have been resilient. If we look at the Manrega, Manrega demand is a good proxy for distress work. Here what we are showing is the current levels, both in terms of work days generated and the actual demand, along with the level in the same month in the previous year. That's your COPPY. So a particular observation that I would make here is the significantly lower level of demand for Manrega work in the month of May, both in terms of work days generated and the demand for work compared to the same period last year, which is shown in the lines, the orange line and the black line respectively in the left and the right charts. So distress work, which was significantly higher last year around this period given the lockdown, it is lower in the month of May and seems to have also declined compared to April, at least in terms of the work days generated, and stayed the same in terms of the demand for work.